Something massive just happened, and almost nobody is talking about it. While mainstream headlines celebrated Japan's election results and painted a picture of stability, professional money managers were quietly doing something very different. They were preparing for volatility. Because beneath the surface, Japan may now represent one of the largest hidden risks to US markets. Today we're going to break down what actually happened in Japan, why interest rates suddenly spiked to levels not seen in over 25 years, how $1.4 trillion could move global markets overnight, why US stocks, real estate, and even your retirement account could be affected, and finally, how investors can protect themselves and potentially profit. This isn't speculation. This is how the global financial system really works. Let's begin. Japan just elected a new prime minister with a massive supermajority. That matters, because with more than 2/3 of parliament seats, there's virtually no opposition. That means new policies can be pushed through immediately. No gridlock, no delays. And the platform is clear. Massive government spending, major tax cuts, increased defense budgets, aggressive economic stimulus. In simple terms, more money entering the system. Historically, that means one thing: money printing. Almost immediately after the election, Japan's 10-year government bond yield surged to its highest level since the late 1990s. Over 25 years. For Japan, this is seismic. Why? Because Japan has lived in a zero interest rate world for 3 decades. Borrowing money was essentially free. Now suddenly, it isn't. To understand the danger, you need to understand something called the carry trade. Here's the simple version. For decades, Japanese investors borrowed money at nearly 0%. They converted that yen into dollars. Then they bought US stocks, US bonds, US real estate, tech companies, ETFs. They earned 4 to 6% returns in America while paying almost nothing back home. It was free money. Trillions flowed into US markets this way. But now that Japanese rates are rising, that free money trade starts breaking. Because suddenly, borrowing costs go up in Japan, returns are falling in the US currency risk increases. So what happens? They unwind the trade, which means they sell US assets. That selling pressure hits stocks, tech, real estate, ETFs, pension funds. And once selling begins, automated systems kick in, margin calls, forced liquidations, algorithmic selling. This is how small moves turn into big crashes. Now here's the part almost nobody's discussing. Japan holds approximately $1.4 trillion in foreign reserves, mostly in US government debt. That's not investor money. That's government money. And the new administration wants to fund tax cuts and stimulus, but instead of borrowing more, they may sell US treasuries. Think about that. If Japan starts selling American debt, bond prices fall, US interest rates rise, mortgages become more expensive, corporate borrowing costs increase, stock valuations drop, the dollar strengthens, exports suffer. It's a chain reaction, all triggered by decisions made in Tokyo. If Japan prints aggressively, other countries must respond. Europe can't allow its currency to become too strong. The US can't afford rising debt payments, so what happens? More money printing, lower rates, currency dilution. This becomes a global race to the bottom. And in every race like this, paper money loses, savings lose, salaries lose. Only scarce assets win. Over the last 30 days, gold dropped nearly 9%, silver crashed more than 26%, not because fundamentals changed, because leveraged traders were forced out. At the same time, a major private credit fund managed by the world's largest asset manager began showing stress. This is what early cracks look like. Not headlines, not panic, positioning. Professionals follow 3 principles. First, follow the money. Watch Japanese yields, watch the yen, watch foreign selling of US assets. Second, reduce exposure to rate-sensitive assets. Highly leveraged tech, growth stocks without profits, commercial real estate, companies drowning in debt. Third, own what cannot be printed. Gold, silver, real assets, strong companies with real cash flow, fortress balance sheets. These businesses survive inflation. They raise prices. They protect margins. They endure. Meanwhile, weak companies collapse. This is not yet a crisis, but it is a pressure point. Japan's election changed global capital flows. The carry trade is under threat. US debt may be sold, interest rates could rise, markets could reprice quickly, and most investors have no idea. History shows us something important. Every major financial event starts quietly. By the time it hits headlines, it's already too late. So the real question isn't, will something happen? It's, are you positioned before it does? Because when governments print, hard assets win, quality wins, preparation wins, and paper wealth fades.